Good day all. Today I am covering Taxation Law 2, second part, exam oriented topics. I am doing this exam oriented topics only for those who can revise before exams, and I am not going to give all the explanations, and I am not going to give what elaboration of every topic. I am just wanted to emphasize only that in those half an hour to 40 minutes in an essay where you will get the time. In that time, how much you can write and how much you can produce, those things are only being discussed here, not more than that. So those who wish to those who want to write, those who are going for exam, it is useful for them only. Let us go into the topics. The topics covered here are remuneration calculation in firm, taxability of family income, GST, advanced tax liability and penalty, tax exemption on import and export. Coming to remuneration calculation in firm. Introduction. Remuneration to partner, that is discussed under section 28 clause 5. Any interest, salary, bonus, commission or remuneration received by a partner from the firm shall be taxable as business income in the hands of the partner to the extent allowed in hands of firm under section 40b. Deductions under section 40b. In the case of a firm, deductions in respect of remuneration and interest to partner under section 40b shall be further deductible from income so computed. Remuneration to a partner includes salary, fees, commission, bonus, etc. The remuneration is allowed subject to fulfillment of the following conditions. The partner must be a working partner. Remuneration must be authorized by the partnership deed. Payment must pertain to a period after the partnership deed. Working partner means an individual who is actively engaged in conducting the affairs of business or profession of the firm. Time devotion, that means the time the partner is spending in conducting the affairs of the business is not the key factor for deciding the status of partner as working partner. Deduction. Remuneration in total is allowed to the minimum of the following: actual remuneration allowed to all partners, and maximum permissible limit under section 40b clause 5 as discussed under. Amount of book profit. What is this book profit? I will discuss later in the next slide. In case of loss, maximum remuneration allowed is 1.5 lakh. In case of profit, first 3 lakhs, 90% of book profit or 1.5 lakh, whichever is higher. On balance book profit, 60% of the next book profit is given. Computation of the book profit. Step 1. Find out the net profit of the firm as per profit and loss account. Next, make adjustment as per section 28 to 44 DP, including adjustment for interest on partner's capital. Add remuneration to partner if debited to the profit and loss account. Subtract unabsorbed depreciation, but do not subtract brought forward business losses. The resultant figure is book profit. What is this unabsorbed depreciations? That will be discussed in the later. Due to subtraction of unabsorbed depreciation, the residual profit should not be less than the brought forward losses, which are to be set off in the current year. Coming to unabsorbed depreciation. What is depreciation? In accountancy, depreciation is a term that refers to two aspects of the same concept: the actual decrease of the fair value of an asset, such as decrease in value of factory equipment each year as it is used and wear, and the allocation in accounting statements of the original cost of the assets to periods in which the assets are used. Unabsorbed depreciation. It is a kind of depreciation that has not been absorbed the expenses or loss of the business. The reason behind its incompetency is the lack of proper accounting of the same in their book of records, making it unaccounted depreciation. So this is an unaccounted depreciation. The bare provisions of the Income Tax Act 1961 have not specifically defined unabsorbed depreciation. The following simple illustrations can help understand it. Suppose A's business profit is 10 crores, depreciation is 11 crores, then unabsorbed depreciation is 1 crore. Thus, unabsorbed depreciation is the situation of depreciation where profit or loss is not even is not even sufficient to adjust the depreciation caused in the business. Therefore, the unabsorbed depreciation is the excess amount of depreciation that is unaccounted as it's not adjusted in profit and loss accounts. This unaccounted profit is perpetually carried forward to the next assessment year to be adjusted or set off against any head of income. For settling the unabsorbed depreciation in the forthcoming year, the assessee has to follow fixed criteria or orders briefed as under. Before carry forward, it has to be adjusted towards current expenditures like scientific research, future planning, or any other depreciation. Adjustment of business loss or capital expenditure, if any. Coming to next topic, taxability of family income. This is an important case law. Hindu undivided family. It is discussed elaborately in family law too. It is treated as a person. The HUF is treated as a person under section 231 of the Income Tax Act 1961. HUF is a separate entity for the purpose of assessment under the Act. Under Hindu law, the HUF is a family which consists of all persons linearly descended from a common ancestor and includes their wives and unmarried daughters. An HUF cannot be created under a contract. It is created automatically in a Hindu family. However, to become an assessee under the Income Tax Act, there must be income yielding joint property of the family. The Delhi High Court held in Commissioner of Income Tax versus SP Chopra that the income from the half share of the property had to be treated as the individual income of the assessee under the personal law and not as the income of the family. The character of the property had to be determined in accordance with the personal law of the assessee and not on the basis of how the property has been treated by the revenue in respect of earlier assessments. A Hindu joint family consists of two types of members, co-partners and other members. Co-partners, the lineal male descendants of a person up to the third generation of such person are known as co-partners. The co-partners acquire on birth ownership in the ancestral properties of such ascendant and have a right to claim partition of such property at any time. However, with effective from 9 September 2005, due to amendment of Hindu Succession Act, the daughter of a co-partner shall by birth become a co-partner in her own right in the same manner as the son. Hence, the daughter can also ask for partition. Other members, such members include wives of male members of the family and other male members. Widow or widows of deceased male members or members are also come under the family, which was discussed in Gauli Buddanna versus CIT 1966. The joint property of the HCF is managed through Karta. The property of the family is ordinarily managed by the father or other senior member of the time. For the time being of the family, he is called Karta. In Narendra Kumar J. Modi versus CIT, it is however held that the senior member may give up his right of management and the junior member may be appointed as Karta with the consent of all other members. In case of Champa Kumari Singhi versus additional member of the Board of Revenue, it is held that in the absence of male member in the family or when all male members are minors, woman member can be treated as manager of the family for income tax purposes. Computation of the income of HUF. Income of HUF is assessed as joint family income of HUF if there exists a co-partnership and joint property of the family till the partition is claimed by any of its co-partners. Joint property of the family consists of ancestral property which a man inherits from any of his three immediate male ancestors, namely father, grandfather and great-grandfather. Accretion, that is growth of the joint family property thereto, and acquisition with joint funds, and self-acquired property of a member thrown by him into the common stock to be treated as family property, that is a converted property. Considerations in computation of the income of HUF. The following are considered in computation during computation of the income of HUF. The holder, who is a senior-most male member of the family of a impartible estate, is liable to tax on income from that estate in his individual capacity, though the estate belongs to HUF. The income derived from the converted property or any property thereof shall be included in the total income of the transferor individual and not in the income of the family. If the funds of the Hindu undivided family are invested in a company or a firm, fee or remuneration received by the member as a director or a partner in the company or firm may be treated as income of the family in case the fees or remuneration is earned essentially as a result of investment of funds. In case of CIT versus Ashok Bhai Chiman Bhai, where it is held that where a member of the HGF is a partner of the firm in the firm on behalf of the family and on partition of the property of the family, the share in the firm is allotted to such a member and no part of the income would be added to the income of the family. This is especially after the partition. Income from the self-acquired property of a member of the HUF, even though he has sons, would not be included in the income of the family. Such income shall be assessed as income of that individual. Any sum paid by an HUF to a member of the family out of its income is not deductible in computing the income of the family. If any remuneration paid by the HUF to the Karta or any other member for services rendered by him in conducting family business, the remuneration is deductible. If the remuneration is paid under the valid and bona fide agreement in the interest of or advantages for the business of the family and genuine and not excessive. If the salary paid by the Hindu undivided family to its Karta for looking after its interest in firms in which it is a partner through the said Karta, such salary is allowable as deduction, which is discussed in case of CIT versus Prakash Chand Agarwal. Income from Sridhan is not includable in the income of the family. Under the Dayabaga School of Law, no son has any right in the ancestral property during the lifetime of his father. If, therefore, the father does not have any brother as a co-partner, income arising from the ancestral property is taxable as his individual income. Computation of tax of HUF is the total income and tax liability of HUF shall be computed in the same manner as in case of an individual, keeping some considerations in mind as explained above. The tax points are tax rate, health rate, and education cess, residential status, computation of income under various heads. There are five heads, as you all know. Clubbing of income, set off and carry forward losses, deductions, return and assessment, advance tax. All these are points which come when computation of the income. Coming to the next topic, GST, Goods and Services Act. Goods and Services Tax was rolled out in India with effect from 1st July 2017. GST is one of the greatest tax reforms in India. It transforms the system of taxation and tax administration into a digital world by adopting the latest information technology. With the introduction of GST, India has joined the club of developed and progressing nations which are already having a common tax on goods and services. Origin of GST. Goods and Service Tax regime is of indirect taxes brought a single tax which was levied on supply of goods and services or both with concurrent jurisdiction of center and states. This led to bringing about amendments in the constitution so that they may simultaneously levy and collect goods and services tax. The Constitution of India has been amended by the Constitution 101st Amendment Act 2016 for this purpose to bring out GST laws governing goods and services, Article 246A has been inserted to enable levy of tax on goods and services simultaneously both by center and state or union territories. Now let us see Article 246A. The 246A was inserted by Constitution in 101st Amendment Act 2016, especially for GST. Article 246A provides that notwithstanding anything contained in Article 246 and Article 254, the Parliament and subject to Clause 2, the legislature of every state have power to make laws with respect to goods and services tax imposed by the Union or by such state. The Parliament has exclusive power to make laws with respect to goods and services tax where The supply of goods or of services or both takes place in the course of interstate trade or commerce. Coming to Goods and Services Tax Council. Section 12 of the Act proposed to insert a new Article 279A after Article 279, which deals with Goods and Services Tax Council. Consequently, 279A article was inserted by the Constitution in 101st Amendment 2016 with effective from September 12, 2016. The GST Council is to make recommendations to the Union and states on the taxes, cess, and surcharges levied by the center, the state, and the local bodies which are subsumed in the GST. It brings about certainty and breaks trade barriers and entry barriers among the states of India, including Jammu and Kashmir. GST Council in a nutshell is Article 279A provides that the President shall, within 60 days from the date of commencement of the Act, by order, constitute a council to be called GST Council. According to 279A Clause 2, provides the constitution of GST Council as under Union Finance Minister as chairperson, Union Ministers of State in charge of Revenue or Finance as members, the Minister in charge of Finance or Taxation or any other minister nominated by each state government as members. The members shall, as soon as may be, choose one amongst themselves to be the vice chairperson of the council for such period as they may decide. Salient points on GST. The first country to implement GST was France in as early as 1954. India has the highest tax slab in the world, 28%, next only to Argentina, which is 27%. Almost 160 countries around the world follow this scheme of indirect taxation. Indian GST has four rate structures like 5%, 12%, 18%, and 28% with cess on sin goods and luxury items. There is a special rate of 3% on precious metals like gold. GST is covered under 5 legislation: Central GST, State GST, Integrated GST, Union Territory GST, and GST of Compensation to States Act. Integrated GST and compensation, cess, and central GST are charged by central government. All taxation policies and their implementation are based on the recommendations of the GST Council. The taxable event under GST is supply. The GST bill was introduced under 122nd Constitutional Bill but passed under 101st Amendment Act 2016. Assam was the first state to ratify GST bill, but Telangana was the first state to pass the state GST bill. 1st July will be observed as GST Day. The threshold limit under GST is 40 lakhs. For some special category states, it is 20 lakhs. There is a special purpose vehicle called GSTN, which caters the IT needs of the GST. The GSTN comes under Companies Act 2013, which combined stake of central and state government is 49%. The rest is contributed by LIC Finance with 11% and ICICI Bank, HDFC Bank, NSE Strategic Investment Corporation with 10% each. The GST Council recommended a uniform policy on e-way bill, which is being implemented all over the country. This totally eliminates the checkpost system, breaking the entry barriers and reducing bottlenecks in transportation. GST Council has also reviewed the rate structure of GST on goods and services. It also recommended reduction of rates on cases of merit. Conclusion in GST is levied by both center as well as states, and there are separate levies in the form of central GST, state GST, and integrated GST, enabling the tax credit across these three variants of taxes. Indian GST system has its own uniqueness in many ways. Apart from India, Brazil is the only country in the world which follows similar dual GST system. In India, GST has been rolled out as a uniform taxation system all across the nation by removing entry barriers between the states. Coming to the next topic, advanced tax liability and penalty. Generally, the tax on the income earned in the previous year is paid in the respective assessment year, but in certain cases, an assessee may be required to pay tax during the previous year itself. This is called advance tax. The scheme of advance tax is based on the concept pay as you earn. Under this scheme, assessee needs to estimate its income and tax liability of the previous year and pay tax on the basis of such estimation in the previous year itself. However, under the scheme of advance tax, assessee is required to pay tax on estimated income of previous year in the previous year itself. This is applicable to all SSC irrespective of his residential status and citizenship. The scheme of advance tax discussed in section 208, where the advance tax liability of the assessee is 10,000 or more, the assessee should pay the such tax in the previous year itself within the due date. Coming to advance tax liability. Estimate the particulars which you look into advance tax liability are which are discussed in section 209. The estimate the gross total income other than income covered under section 44 AD, less the deductions under chapter 6A, which includes ATC, that is tax saving investments, which the assessee will do. This gives estimated total income. Next, gross tax liability on estimated total income less the rebate, with rebate under section 87, that is the income less than 5 lakhs, rebate of 12,500 will be given. Tax liability after rebate is calculated and add the surcharges and add health and education tax. Approximately it will be up to 4%. The tax liability after cess less the tax deducted, that is TDS deducted at the source or other rebates relief, and this gives advance tax liability. The due dates of payment of advance tax. The due date, an eligible assessee in respect of an eligible business referred to in section 44 AD or 44 ADA, the due date of installment is on or before March 15th and 100% advance tax liability is to be paid. Other assessees, that installment should be paid in four stages on or before June 15, September 15, December and March 15. And the amount payable is 15%, 45%, 75% and 100% of advance tax liability. Important considerations in advance tax liability. Any amount paid under section 211 on or before 31st March of the previous year shall be treated as advance tax paid during the financial year. Senior citizens not having business income is not liable to pay advance tax. Where the assessee has paid the whole of the amount of tax payable in respect of such income, apart from as part of the remaining installments of advance tax which were due, or where no installments were due by March 31st of the financial year immediately preceding the assessment year, then it is deemed that all provisions are complied. While calculating the advance tax, net agricultural income shall also be taken into consideration for computing tax liability. If an assessee does not pay any installment within due date, he shall be deemed to be an assessee in default in respect of such installment as per section 218. Any sum other than a penalty or interest paid by an assessee as advance tax shall be treated as a payment of tax on the credit for such shall be given to the assessee in regular assessment as per section 219. Procedure for payment of advance tax. Two types of procedures are seen: on assessee's own motion or on receipt of order from the assessing officer. Let us see on assessee's own motion dealt under section 210. The procedure for first installment. Make an estimate of current year's income excluding the income covered under section 44 AD or 44 ADA, considering brought forward losses after deducting all allowable deductions under chapter 6A, which were discussed in the previous slides. Compute the tax liability on above estimated income at rates in force during the financial year and reduce rebate if any. Add surcharge if applicable. Add health and education cess, that is 4%, that is the maximum. Deduct tax deducted or collected at source like TDS. The amount so derived is advance tax payable. Procedure for subsequent installments. Check is if estimate of income made earlier requires revision. If not, deposit appropriate amount of second, third, and fourth installments of advance tax. If estimate of income needs revision, then make a revised estimate and compute tax liability thereon. Determine advance tax payable in subsequent installments after deducting the amount paid in earlier installments. Deposit such advance tax. On receipt of order from the assessing officer, which discussed under section 210(3) or 4, the assessing officer may pass an order and issue a notice of demand under section 156 requiring the assessee to pay the advance tax. Conditions to be satisfied for issuing such order. The assessee has already been assessed by way of regular assessment in any previous year. The assessing officer is of opinion that such person is liable to pay advance tax. Such order can be passed at any time during the financial year, but not after last day of February. Such order may be made in writing. Such order also specifies the amount of advance tax and the installments thereof to be paid by the assessee. Determination of advance tax by the assessing officer. The amount determined by assessing officer shall be the higher of the following: the tax on latest assessed income as per regular assessment, or tax on income declared by the assessee in the return relating to the previous year subsequent to the previous year for which regular assessment has been made. Interest on non-payment of advance tax. Where an assessee fails to pay advance tax or defers the payment of advance tax on specified date, he shall be liable to pay interest under section 234B and 234C. Let us see illustration. Find out the amount of advance tax payable by A on specified dates for the financial year 2018-19. The business income, the tax of 544 rupees is deducted at source, and the business income is 4,91,000 and agriculture income is 86,000. Computation of tax liability of A for the previous year 2018-19. Particulars are: tax on 5,77,000, that is a total 86,000, and non-agricultural income 4,91,000. If the tax is valuated, it comes around 27,900. Coming to the less tax on 3,36,000, that is 3,36,000 is a non-taxable amount, that is 86,000 of agricultural income and maximum exempted limit of 2.5 lakh, that comes around 4,300. So deduct it and you will get the tax liability as 23,600. So under now less the rebate, which is not given, and add the health and education tax, that is a maximum 4%. 4% of the 23,600 comes around 944. So the tax and cess payable now is 24,544. The TDS which has been cut before is 544, which is less. That is the total amount of advance tax payable is 24,000. Coming to the next topic, tax exemption on import and export. Introduction. The taxation laws have laid down the taxes applicable on import and export of goods and services. In the current tax regime, laws of custom duty, excise, service tax, and VAT lay down the tax treatment of imports and exports. In the GST regime, excise, service tax, and VAT will be subsumed into GST, and customs duty will continue to be levied separately. Now let us understand the tax implication on imports and exports. Import of goods. In the GST regime, a person who imports goods has to pay customs duty and IGST, that is integrated GST. The difference here is that CVD, that is countervailing duty, and special additional duty SAD levied on imports in the current regime will be replaced by IGST under GST. IGST will be levied at the rate applicable to the imported goods in India. An importer can claim full tax credit of IGST paid on imports. Hence, importers who were unable to claim the credit of CVD and SAD in the current regime can now claim full tax credit of the IGST paid on imports. However, no tax credit will be given on customs duty paid, and it remains a cost for the importer under GST also. Let us see the example. Shubham Apparel in Rajasthan purchases apparel from a supplier House Designs in Sydney, Australia. The tax calculations are: women's t-shirts number 200, per piece 2,500, the total price is 5 lakhs. Men's t-shirts 100, 5,000 per piece, that is 5 lakhs. Total 300 pieces, that comes around 10 lakhs. The custom duty is 10%, that is fixed, that is 1 lakh, and education cess is 3%, that is 3000 as added. So the subtotal comes around 11 lakhs 3000. Now on that AGST of 18% is added, that is 1,98,540, and the total cost of import for the person to import the all the things, all apparel, is 13 lakhs 1,540. Import of services. Under GST, a supply will be considered as an import of the service when the supplier is located outside India and the recipient is inside India and the place of supply is in India. For example, Rajesh Apparels in Hyderabad, Telangana avails fashion designing services of 50 lakhs rupees from Kaushi Designs in Colombo, Sri Lanka. The location of supplier is Colombo, Sri Lanka, and the location of recipient is Hyderabad, Telangana. Tax calculations. Particulars. Fashion designing services are 50 lakhs. IGST 18%, 9 lakhs. The total cost of import is 59 lakhs. Coming to exports. Under GST, exports will be zero rated, similar to the current regime. An exporter can also claim refund of the tax paid on the inputs used to manufacture, purchase, provide the exported goods or services. Export of services. Specific conditions have been laid down for a supply to be considered an export of service under GST. These are: supplier of the service is located in India, the recipient is located outside India, and the place of supply is outside India. The payment of the service has been received by the supplier in convertible foreign language, and the supplier and recipient are not establishments of the same person. Tax exemption. A tax exemption is the right to have some or all of one's income exempt from country's taxation. The majority of taxpayers are eligible for a number of exemptions that can be used to lower their taxable income, while some people and organizations are fully free from paying taxes. Section 10b gives that the profits from complete export-oriented undertakings, manufacturing articles, or computer software for 10 years. The exemption is in these areas are for 10 years. Thank you. Please like, share, subscribe, and comment.